Hello, entrepreneurs. Joe DiChiara, CPA extraordinaire, coming to you with another exciting episode of Learn to Earn business tips in less than 5 minutes. That's right, folks. We're going to cut right to the chase. And today we're going to talk about a subject that most people really aren't comfortable with, and that's making sure your estimated taxes are being paid on time, and more importantly, that you're actually covering enough of your tax liability to avoid any kind of late payment, interest, and penalties. So, how do you do that? There's a couple of ways. Number one is through tax withholding. So, if you have a job or retirement, you can actually ask the payer to withhold your federal and state taxes. But that's not enough. You got to make sure that you're withholding enough. But we'll get to that in a second. Another way is to have your last year's refund applied to next year's taxes. Now, I don't always like this because, again, we're going to go to how much do you actually have to have paid in. I don't want to overpay for the simple issue of cash flow. I don't want to pay the government more than what I have to. I just want to pay them enough. The other option is to make quarterly estimated payments. So let's go through what you actually have to have paid in. First, let me introduce you to the concept of pay as you go. Okay. You're really only required to pay taxes as you earn the money. So let's say you make no money, you have zero income for the first 3 quarters of the year. And then in the last quarter is when you make 100% of your income. So technically, your taxes don't have to be paid until January 15th of the following year. So that's when the quarterly estimate would be due. Now, the way that you prepare your return is going to determine how the penalties and interest are calculated. So the IRS isn't going to automatically know, hey, this individual made all of their money in the last quarter. You have to tell them, and there's a form that will allow you to annualize your income. In other words, you'll break it down by how much money did you make each quarter. Now, the first factor that the IRS looks at is your previous year's tax return. How much did you owe the previous year? So as long as you cover 100% of last year's taxes, you will not be subject to any kind of interest and penalties. So you want to cover the first rule is 100% of last year's taxes. The second rule is you have to have at least 90% of this year's taxes paid in. So it's either 100% of last year or 90% of this year. So how do you calculate that? Well, you got to be up to date on your tax projections. So the way I do it is we take the slice of the part of the year. So if it's the first half of the year, guess what I'm going to do? I'm going to double it and say this is how much I'm going to owe by the end of the year. So that's my story. I'm sticking with it. I want to keep it below the 5 minutes. If you would like to book a chat with me to talk about this or any other business or individual tax issues, just go to Time with Joe and mention that I invited you to a free chat in this recording. Okay, that's my story. I'm sticking with it. Over and out. God bless, and I will see you on Monday with another episode of Learn to Earn.